There are 47,000 homes for sale in Florida right now with a 2.5 to 3.5% interest rate locked in from 2021. If you can find one of those homes and assume the loan, you can buy a $600,000 house for a $400,000 payment. You can qualify for $200,000 more house without making an extra dime in salary. And you can drop your monthly payment by over $1,000. Most agents have never done this deal. Most banks don't advertise it, but it's 100% legal. And I'm going to show you exactly how to do it in the next 12 minutes. It's called a mortgage assumption, and it's the only legal way to step into the seller's 2021 interest rate and make it your own. We're going to cover exactly how to find these homes, how to qualify for more without getting a pay raise, and one dangerous mistake involving your credit card that'll kill the deal on the spot. And the 3 test questions you need to ask your agent to make sure they don't screw this up. I'm Tom McNamara, the Florida Real Estate Insider. Let's get into it. Let's get this concept sold first. Most buyers today are timing the market, waiting for rates to drop. That is a losing game. Here's why timing is a trap. If you wait for rates to drop from 6.5% to 5%, every other buyer is waiting too. When rates finally do drop, demand is going to surge, prices are going to spike, and you're competing against 15 offers all over again. You waited for a better rate, but now you're paying $50K more for the same house. You didn't win, you just got in line. The pros aren't timing the market, they're structuring the deal. When you get a standard loan today at 6.5%, for every 1% that rates go up, you lose 10% of your buying power. But if you assume a mortgage, you step into the seller's contract. You keep their 2.5 or 3% rate from 2021. Because the payment is so much lower, your debt to income ratio stays low, which allows the bank to let you buy a much more expensive home. You aren't cheating the system, you're just using a more efficient piece of math. You're not waiting for the market to change, you are changing the deal. The loophole is buried in government-backed loans, FHA and VA. Here's how it works. FHA loans, these are open to anyone creditworthy. You don't need to be a first-time home buyer. You don't need a special status. The catch, you do have to live in the home as your primary residence for at least a year. The bank will do a full credit check and income verification, but you're inheriting the original loan terms, including that 3% rate from 2021. VA loans, this is where it gets a little wild. Stop, rewind, listen to this carefully. You do not have to be a veteran to assume a VA loan. Let me say that again. A civilian can take over a veteran's 2.5% mortgage. Most people don't know this. Most agents don't know this. But it's in the VA handbook and it's 100% legal. The only catch is that the seller's VA entitlement stays tied to the house, unless you're also a veteran who can substitute your own entitlement. If you're a civilian, the veteran seller can't use that entitlement again until you sell or refinance. That's why some vets won't do it, but plenty will if you're paying full price and closing fast. This is the most underutilized tool in real estate right now. There are thousands of VA loans sitting out there with sub 3% rates, and you can assume them. Now, here's the only real hurdle, the equity gap. Let's say the house is worth $400,000, but the assumable loan balance is only $370,000. You need to come up with the $30K to bridge that gap. Here's where people get desperate and blow the deal. You've got $10K saved up, so you think, what if I just take a $20K credit card cash advance to cover the rest of the down payment? Then I'll pay it off later when I get my bonus or my tax refund. Do not do this. Underwriters for assumptions are strict about sourcing funds. They need to see where every dollar of your down payment came from. If they see a sudden $20K spike in credit card debt, new cash advance accounts, or unexplained deposits in your bank account, they will flag you for debt to income violations or suspicious activity. Credit card advances are specifically prohibited for down payments. Use it and you lose the house and your earnest money. So, what do you do instead? Option A, get a second mortgage. You can get a second loan to cover the gap. Even if that loan is at 9%, when you blend it with a 3% first mortgage, your total effective rate might be around 4.5%. That's still way better than a new 6.5% loan on the full amount. Option B, a seller carryback. This is pro level stuff. The seller acts as your bank for that 30K. You pay them monthly at a negotiated rate, maybe 5 to 7%. This helps the seller get their full asking price, and it helps you keep that low rate first mortgage without needing a pile of cash up front. Here's the pitch to the seller. You get full price, I close in 45 days, and you earn 6% interest on the carryback instead of letting that money sit in a savings account earning less than 1%. Most sellers have never heard of this, but once they understand it, a lot of them will say yes. Option C, gift funds or a family loan. If you have parents or family willing to help, gift funds are allowed for FHA and VA assumptions as long as they're properly documented. A family loan with a promissory note also works. Just make sure it's disclosed to the lender up front. The key is this: any money you use for down payment has to be sourced, seasoned, and documented. If the underwriter can't trace it, they will not approve it. Now, let's talk about speed. Assumptions are slow. 45 to 90 days. Banks aren't in a hurry to give you a 3% rate when they could give you a new loan at 6.5% and make a whole lot more money. To fix this, you can use a facilitator like Rome. They act like a quarterback, managing all the paperwork between you, the seller, and the lender. They do charge 1% of the loan amount. Let's say that's $5,000 on a $500,000 loan. Here's why it's worth it. If you're assuming a 3% loan instead of taking a new 6.5% loan, you're saving about $1,000 a month. Over 30 years, that's $360,000 in savings. You're paying $5K to save $360K. That's a 72 to 1 return. And here's the kicker. Rome offers a 45-day guarantee. If the bank stalls past 45 days, they'll pay the seller's mortgage until the assumption closes. That protects you from losing your earnest money if the lender drags their feet. That's not a fee, that's insurance. You cannot use a standard way agent for this. They will kill the deal. You need a creative structural specialist. Here are 3 test questions. Question 1. Are you familiar with the novation process for FHA assumptions? Question 2. What is your strategy for substitution of entitlement on VA loans? Question 3. Will you work with a facilitator like Rome to manage the 45-day timeline? If they look at you like you have 3 heads, fire them on the spot. Standard is just code for expensive. You need an agent who knows how to structure deals, not just how to unlock doors and hope for the best. Here's what you do next. Download the Time Machine Strategy Cheat Sheet in the description. It has the 3 agent test questions, the equity gap calculator, and a breakdown of the top 10 Florida neighborhoods with the highest concentration of assumable loans. Then go find your house. The clock's ticking. There's only 47,000 of these left. Every month, more of them disappear as sellers refinance or pay off their loans. Don't wait for rates to drop. Don't compete with 15 other offers. Step into the time machine and steal a 2021 interest rate before someone else does.
And look at that. I thought it would take 12 minutes and didn't even take 10. Don't overcomplicate the one thing that could save you thousands of dollars in interest and be the one difference between your dream home and renting for life. If you need help breaking down any of this, book a call with me by clicking the link in the description below.
Hey, I'm Tom McNamara, the Florida Real Estate Insider. I'll see you in the next one.